Hi everyone, I'm Divya Grover, here to help you take informed mutual fund investment decisions. Mid-cap funds have become increasingly popular among investors over the years because of their strong return potential. They have the ability to deliver high growth than large-cap funds while still maintaining a balanced risk profile. But it is important to remember that even within mid-cap category, funds can differ significantly in terms of investment style, portfolio strategy, risk profile, and return potential. A great example of this is HDFC Midcap Fund and Motilal Oswal Midcap Fund. Both have delivered impressive returns over the last 5 years, but they have achieved those results through very different investment strategies. In this video, we will compare these two funds across key parameters including historical performance, risk-adjusted returns, and portfolio composition to understand how their different approaches have influenced their outcomes. The first thing investors usually look at is returns. So let's start here. Looking at 5-year returns, Motilal Oswal Midcap Fund emerged as the category topper, delivering a CAGR of 22.5%. In comparison, the Nifty Midcap 150 TRI index registered a growth of 17.6%. The fund also outperformed the category average return of 16.8%. HDFC Midcap Fund also ranked among the category's top performers during the same period, delivering a CAGR of 20%, although it was slightly behind Motilal Oswal Midcap Fund. Now let's move beyond returns and see how much risk each of the fund took along the way. Because returns tell only part of the story, it is equally important to understand the level of risk taken to generate those returns. Motilal Oswal Midcap Fund recorded an annualized standard deviation of 19%, the highest in the category. In comparison, HDFC Midcap Fund had a standard deviation of 14.4%, making it one of the lowest in the category. This indicates that while Motilal Oswal Midcap Fund generated higher returns, it also experienced significantly higher volatility, resulting in sharper swings in investors' portfolios. On the other hand, HDFC Midcap Fund's lower standard deviation reflects smaller fluctuations around its average annual returns and greater consistency in performance. Now let's look at risk-adjusted returns, measured using the Sharpe and Sortino ratio. The Sharpe ratio measures the excess return a fund generates for every unit of risk it takes. The Sortino ratio measures how effectively a fund manages downside risk. On both these measures, HDFC Midcap Fund stands out. Its Sharpe ratio of 0.3 is currently one of the highest in the category. By comparison, Motilal Oswal Midcap Fund's Sharpe ratio is 0.22, one of the lowest in the category, and it also trails the benchmark. The fund's Sortino ratio has also been relatively weak compared to both the benchmark and most of its peers. Meanwhile, HDFC Midcap Fund's Sortino ratio remains superior to the benchmark and the majority of funds in its category. So while HDFC Midcap Fund delivered stronger risk-adjusted returns, Motilal Oswal Midcap Fund was less effective in rewarding investors for the additional risk it took. Finally, let's compare their portfolio composition and investment approach, which plays a key role in shaping both returns and risk. Motilal Oswal Midcap Fund maintains a concentrated portfolio of around 30 stocks, with its top 10 holdings accounting for about 53% of total assets. The fund also holds many of its investments with a short-term view and has recorded a relatively high portfolio turnover of around 85 to 140% over the last 1 year. A concentrated portfolio can generate significant alpha if the fund manager's stock selections perform well. However, if those investments don't work as expected, the downside can also be much higher. In addition, the higher portfolio churn can further increase the fund's volatility. In contrast, HDFC Midcap Fund maintains a diversified portfolio of around 75 to 80 stocks, while keeping the allocation to each stock below 5%. Its top 10 holdings account for about 33% of its assets. The fund follows a high conviction buy and hold approach, with most investments held from a long-term perspective. As a result, it has maintained a relatively low portfolio turnover of 5 to 15%. This strategy reflects the fund's focus on risk management and steady returns instead of pursuing higher returns by taking higher risk. In conclusion, Motilal Oswal Mid-Cap Fund follows a concentrated investment strategy combined with high portfolio turnover, which can potentially generate substantial alpha during favorable market conditions. However, that approach can also lead to higher downside risk and greater volatility, making the fund riskier than many of its peers. HDFC Midcap Fund, on the other hand, follows a more conservative approach by focusing on companies with long-term potential rather than chasing market momentum. This strategy can potentially result in consistent returns that often outperform the benchmark while maintaining a reasonable level of risk. The comparison also highlights that even funds within the same category can differ significantly in terms of portfolio strategy and the balance between risk and reward. That's why investors should carefully evaluate mutual fund schemes across multiple parameters and choose the one that best aligns with their investment objectives. If you found this comparison useful, don't forget to like, share, and subscribe for more insights on mutual funds and investing. Thanks for watching. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.